Hey folks, it's David House here from the Property Factory, joining you, and thanks for joining me for tonight's webinar. Do you want to just, do you mind just popping in the chat box there if audio is good, so I just know that you're hearing me okay. That would be good just to know as we get started on tonight's webinar. And thanks for joining me on time. That's much appreciated. Oh yeah, Jeff says he can hear me. That's great. Thanks, Jeff. So thanks for getting here on time. So Campbell was due to take tonight's webinar, but unfortunately this week he was he headed away for 3 days R&R and headed to the west coast of the South Island and had a unexpected vehicle breakdown. So I am hosting this webinar tonight with you, and it's on analysing the numbers so you can work out if it's the right investment for you. So tonight's webinar, again, it's a webinar we haven't done before in the sense that we put the content together specifically for tonight, or I have, and it really is designed to spend quite a bit of time on analysis and really focus on the numbers. So if you've got a head for numbers, you're going to enjoy it. If you haven't got a head for numbers, you should stay tuned, because real estate, as you know, is all about the numbers, and the numbers making sense first and foremost. And so tonight I want to step through those with you, just give you some tips really, as well as a market update and some other bits and pieces. So we're going to look at brief market update. Going to talk about some of the examples of locations that generate positive cash flow from new property purchases, and that being positive cash flow after all the costs are paid, and assuming you borrow 100% because you've got equity in something else. And obviously if you borrow less than 100%, then you're going to have better cash flow. We are going to spend some time on the balance between rental yield and capital growth, and what makes sense, and can you buy for both. The history, of course, if you started investing 20 or 30 or 40 years ago, as you'll know, is often we bought in high capital growth locations where the yields were really poor, or really low, or we bought in high cash flow locations where capital growth was very, very low. So, and often those locations where there were high yields and low growth rates were secondary towns, regions, lower socioeconomic areas and stuff like that. And we're in a market today where, due to the change in two things, interest rates and also the reduction in the size of the average piece of land, that you can actually buy for rental yield and capital growth, and it doesn't have to be a trade-off. But we'll talk more about that. And we're going to talk a bit about what makes sense right now in terms of investing in house and land versus townhouses versus apartments. So the Property Factory, as many of you will know, if you've been with us for some time, was founded by Campbell Venning originally some 10 years ago. And the Property Factory is a solution designed for, on one hand, developers, builders, vendors who have the need for volume property sales. We negotiate new projects with vendors. We negotiate in bulk and make those listings available to our members who get access to brand new property projects, sometimes at discounted prices, sometimes with extra add-ons or benefits, sometimes because they're early stage in development. But essentially, as a member, which membership is free, it allows you to get access to quality projects across the country. And given we've got a lot of people that have joined the Property Factory recently, I'll jump into a little bit more, 2 or 3 minutes on why these projects make sense and what's our criteria for selecting those. But essentially, our goal is to provide property investment opportunities that are better than anything else in the market across the country. We handpick those, and we handpick them in the sense that for every 10 to 20 projects that we look at, one of them might stack up in terms of the attributes that we look at as part of our selection criteria. And I'll talk about that in more detail shortly. But essentially, I partnered with Campbell in the Property Factory 2.5 years ago to build the technology platform you now see that makes the information available across the country, and collectively across the last 25 years, Campbell and its related businesses have sourced and sold more than 2,300 properties in that time. And if we look at the people that are in our business today, I think we've got 12 or 13 people in the business now. If you look at their real estate specific experience, exceeds 125 years between them. So the property factory's focused on sourcing quality investment properties, and they're new and based on a number of different strategies. And that might be discounts through buying in bulk. It might be access to early stage land subdivisions or house and land packages where you come into a development to stage one, and as a result, the developer has a staggered project sales plan over the next 1, 2, 3 years. And if you come in an early stage, and often you get better pricing than you would at stage 2, 3, 4, 5, because quite simply, the developer will have a master plan over the space of a number of stages in the project. That often means that they achieve an average price across the entire project, but that's usually a ratio of lower prices in early stages to stimulate investment and demand. And then as the project develops, as construction gets underway, as earthworks get underway, as infrastructure goes in, i.e. schools, kindergartens, shops, petrol stations, etc., then prices generally tick up over time as that project progresses. So our members get access to early stage opportunities, which then automatically results in capital growth, usually over the following 1 to 3 years as that project matures in terms of its sell-through phase. The other thing is, not a lot of people understand that for developers to start a project, they often need to hit pre-sales targets. And so the bank might say, until you've sold 60% of this property or this project off the plan, we're not going to give you funding to get your project underway. So again, developers usually have secured land, they've got resource consent, building consent, they've got people on the team, they've got all sorts of costs going out. And so to get a project to the stage where earthworks can start, followed by construction, is obviously pretty sort of key stage for a developer. And some projects, depending on the scale of those, if you take a 400 unit apartment building, of course, could take 1, 2, or 3 years to get to that earthworks stage and construction starting. So for any developer to move on to the next project, they've got to complete the current project, and that's where the property factory will often be able to negotiate benefits and discounts to help the developer get to that initial pre-sales target stage, where they sell some of their stock to investors at great rates, and then some through retail channels like Harcourts, Baileys, etc., through TradeMe and realestate.co.nz. Okay, so in terms of the types of projects that we bring to the property factory, and if you're a member, you've joined up for free wholesale membership, you'll know that when you log in to the website and the members dashboard, there's a whole bunch of property projects that are available in there. How do they get there? Well, we start off by following a pretty detailed due diligence process. And so first step is to focus on the locations that make sense based on the property cycle and the property clock, and we'll talk a little bit more about that shortly. Second step is, what are the things happening in that location from an infrastructure point of view that's going to help drive demand, population growth, help drive extra capital growth in the future at a greater rate than what we've seen in the past. And so an example is, if you take Christchurch, of course, you've got motorways, you've got a new city being built, you've got stadiums going in, you've got large commercial office buildings that are going to or already are employing hundreds of people in individual buildings alone. You've got things that cause changes in an area that drive growth, so infrastructure plans. And then the next thing we look at is the developer's track record or their DNA. What is their history? What have they built already? What have they delivered? Did it match the specifications? Are their customers happy? Do people say good things about them? Et cetera, et cetera, et cetera. So all of those things are part of the consideration before we even get to looking at, the project or the product. What's the performance of the area been to date over the last 20 years in terms of growth? And then how likely is that to continue at that rate or a greater rate in the future? And once all of that kind of stacks up and makes sense, and we say, yep, location tick, yep, upside tick with infrastructure, yep, developer tick. Okay, now we're at the product stage. What's the product? So house and land, townhouse, apartment. Who's it designed for? Who's the buyer? Who's the tenant? How have they spec'd it out? Have they overcapitalized it? Is it larger than it needs to be? Do the rental returns make sense relative to the cost of the project or the property? What are the yields? What are the cash flows? What are the body corps, et cetera, et cetera, et cetera. So does all of that stack up? And then if we get to the stage where we say, yep, that makes sense. And then in terms of, then it's around market timing. Does it make sense for this location right now? What else? What other projects are in the market? How fast are they selling? What are they selling for? What are the weaknesses and strengths, et cetera, et cetera. And then I guess above all else, then despite all of those things being green lights, and then there's a level of experience and judgment based on the understanding of the country, the understanding of the markets, understanding of what's been before, the highs and lows, and sometimes you just get a bad feeling about a developer or project for no other reason than just you do based on judgment and experience. And so hence why we will review 10 to 20 projects before we get a new project that we then list and market and offer to our members through the Property Factory website. And we are a licensed real estate agency, and unlike traditional real estate agencies where they list a property, then they sell it to whoever they can. Our whole focus is we bring on our members, we talk to them about their strategies and their plans, we look at where they're weak or where they're strong in their portfolio and what they need next, and that's really the conversation we have, as opposed to, hey, we've got this project, you should buy it. We work with a number of developers across the country, we work in a number of different locations, and we deal in houses, townhouses and apartments. And if you take one of our larger developers that we work with, even within that relationship, for every 10 projects he releases, we might pick 2 or 3 that stack up, because not all of them do, because there are a number of projects that are designed for owner-occupiers, where the specifications and the sizes to a higher or larger spec, where the numbers don't make sense from a property point of view. And an example is, you can build a 2-bedroom apartment that retails for $500,000 in Christchurch, or some parts of Wellington. You can build a 2-bedroom apartment that retails for $700,000 in those locations. And clearly, just because you spend 40% more doesn't mean you get 40% more rent, but that's all about who the target is and who the ideal end customer is. So, as much as we have probably 2 out of every 10 projects are completed now and ready to move into or ready to rent out, 80% of what we do is what we call off the plan, where you're purchasing a property based on plans, specifications, images, renders, drone footage, essentially the kind of concept you'd get from an architect if you bought a bare section and wanted to build something on it. And the advantage of that is, in many cases, these projects are settling 1 to 2 to 2.5 years out. So that even though today you're purchasing that property, you're often putting down a 10% deposit, you're not settling that for 1 to 2 years. And if you buy in rising markets where capital growth's occurring, then what can happen is, by the time you settle that property in 12 or 24 months, maybe the price has increased another 10% or another 20%, because you're purchasing in today's price, even though you're not settling into the future. So often the challenge for developers is they have to sell at today's price based on the value today, even though they've got rising costs of materials and labour, that if they can't lock all of those in, means sometimes their margins can be eroded as time ticks on. So the beauty of buying off the plan is your deposit, which is usually 10%, goes into a solicitor's trust account. It's locked up until settlement. If the project doesn't proceed for some reason, then you get your deposit back, and it's protected by law. And so that's the risk of the buyer, which is compared to the risk of the developer, it's a pretty good deal. And so through the Property Factory, you get access to projects that are newly released. And you get to take advantage of what's a reasonably common capital growth strategy by being in at an early stage and then having the ability to settle in the future in a rising market, the ability to generate capital growth before settlement. So tonight, if you've got questions at all, please type them into the Q&A box, and I'll make sure I answer those along the way, or every so often have a bit of a break. My name's David House, and welcome to tonight's webinar. If you logged in sort of five minutes late or so, like I see, we had a whole lot of people join us in the last sort of 10 minutes, and I'm taking you through tonight's webinar, which is really focused around market analysis and property analysis, and a bit of a technical episode tonight. Again, if you've got questions, make sure that you fire those through to me so I can answer all those. So most of us understand that the property market is cyclical, and we use what's called a property clock to explain that as best we can, to really, I guess, explain why we focus on different locations at different times. And so the clock itself, if you think about the hands on a clock from 1 to 12, we use 12 o'clock to symbolize the peak of the market. So if you think about Hamilton and Wellington right now, and we'll look at the data soon, they've had pretty strong capital growth now for the last 4 to 5 years. And so once you get a market that's well advanced, that's had rising sales, rising prices, rising volumes for a period of time, you get to the point where often prices may grow 50 to 100% in a cycle and rents don't keep up. They might grow 30, 40, 50%. So what happens is, because rents grow slower than property prices, then yields as a percentage drop, and you do start to get to the point where affordability or poor returns kick in. At the moment, we've been partially subsidized by reducing interest rates over the last 3 years. And as they've come down and down and down, even though yields have got lower in some of those stronger markets, off the back of that capital growth, we've still got markets that are still growing in value, even though they've had an incredible amount of growth in 4 to 5 years. And so when we see a market at sort of 10 to 12 o'clock, generally we think that it's coming to the end of its growth phase, or it may already have peaked. And so as investors, we will generally avoid those types of markets because, of course, if you buy at the peak right now, as Auckland peaked in lots of locations, lots of parts of Auckland in sort of mid-2015 to mid-2016, as you'll see by the data, prices have now gone sideways really up until about 6 to 12 months ago. And so, arguably, if you bought 4 years ago, you're no better off than if you bought 6 months ago in most of the Auckland market. So as investors, what we aim to do is time entry into the market to where prices have bottomed out. There's an undersupply as a result because developers have stopped developing at the same rates. Rents are starting to rise because of stock shortages. Demand starts to rise. Prices start to rise on the back of lack of supply, plus improving yields, and away the market goes again. So our philosophy is to invest at that sort of 6 to 7 o'clock phase and come into a rising market. And I kind of compare it to, imagine when you're at Auckland International Airport and you get on the travelator when you get off the plane, and you're walking at the same speed as the person next to you, who's walking up the sort of normal hard concrete floor to customs. You're on the travelator walking at the same speed but going twice as fast because you're in a rising market, right? And like they say, a rising tide means all boats float higher. And that's what you want to do, is you want to enter the market in a growth phase, so you're instantly getting capital growth off the back of the property you've purchased, even if it's off the plan, as opposed to sitting on your hands and going sideways. Right, so I'll just take a quick breather. A couple of questions here. Somebody by the name of Anonymous Attendee says, since the Christchurch market is a flat market at the moment, does it mean that buying off the plans won't give the benefit of increase in value on settlement? So we'll answer that question on tonight's webinar, but just to be blunt with you, Christchurch is not a flat market. It's now anywhere between 6 and 18 months into its next growth phase. Rents are rising, and I'll show you some data from a number of independent sources tonight to support that. But absolutely, if we take a different example, just to your point, if you invest in a flat market and it's a flat market that's recently leveled out, then absolutely, if the market's not rising or due to rise, then buying off the plan doesn't really give you a lot of benefit at all. That's right. So getting the timing right with off the plan purchases is pretty important. So Osako says, so where are we now at on the clock? So Osako, we'll come back to that because, of course, New Zealand is a market of many markets, and even Christchurch and Wellington and Auckland are markets of many markets. So I'm not trying to evade the question, but I'll give you some examples shortly where the market's up to around the country. So I'm a big follower of Tony Alexander's economic reports. He's been with the BNZ forever. When I say forever, I don't know. Back in the 90s, he was with the BNZ, and it doesn't seem to age. He's an incredibly intelligent economist, and he publishes market reports on a monthly basis. Is paid by the BNZ to do that as part of understanding where the market's going. And I guess at a high level, sales are increasing, time to sell is reducing, immigration has hit one of its highest points in 20 years. The annualization of inflow in the most recent months has us rolling at about 100,000 new people a year. We've got a lot of Kiwis returning from overseas at the moment, despite the immigration issues around COVID-19. And it's expected that will grow at about 80,000 people over the next 12 months and have the need for about 30 to 35,000 new dwellings. We continue to have a shortage of about 50,000 dwellings in New Zealand, and as a result, we keep having pressure on prices and rents rising. So interest rates are forecast to continue to drop, even though they're now 2.6, 2.7, 2.9. You're starting to see some crazy rates at 2.2. And as investors or first home buyers, anytime that you can get a yield of 4.5% to 5%, but only pay 2.5% for the money, it's a no-brainer, right? And if you're a tenant right now and you're renting a property on a 4.5% to 5% yield, but you can own it for 2.5%, again, it's a no-brainer, right? In many cases, your mortgage payments on interest only will be half of what your rent is, and so it makes sense to own and not rent. So from Tony's point of view, he sees prices continuing to rise across the country. And since this article was published about 3 weeks ago, we've seen more data come out on what's happening in locations, Auckland, Wellington, Christchurch, Hamilton, and stock shortages and rising prices and volumes. And only key areas, Queenstown, which you think about that, hugely reliant on international tourism, had quite a big Airbnb market. Obviously, there's some structural issues there right now. Domestic tourists won't replace internationals, particularly spending power-wise for the foreseeable future. And in Invercargill, of course, you've got the Tiwai Point aluminium smelter closing down, and that employs about 1,000 people, I think, and not to mention all the related industries that feed off that as well. So his summary is housing is undersupplied. So New Zealand's population in March passed 5 million. It only took us 17 years to go from 4 million to 5 million. The fastest million new people we've ever had in history, and the growth rate's not slowing up. And so if you look at the sort of four big capital cities right now, if you look at Auckland in the dark blue at the top there, if you look late 2016 through to now, largely gone sideways as that market flattened out after a huge period of growth, and then the worms just started to turn in the last 6 to 12 months. You see there in the brown, Wellington, and in the tan, Hamilton, have both had fantastic growth really since sort of mid-2015 all the way through to now, with no signs of that abating. So well advanced in the next phase of their growth, some years into that next growth phase. You see there in the light blue, Christchurch, after getting some adjustment after the earthquake, has largely gone sideways for the best part of 7 or 8 years, and then just started to sneak up in the last 6 to 18 months, depending on which suburb you're in Christchurch, based on the city centre versus east of the city versus west of the city. And we did a bit of analysis on a couple of webinars ago now on what drives Christchurch. So in New Zealand, the green line, and so you can see the obvious examples there of Christchurch and Auckland going sideways. So more broadly on the South Island, you can see why there's warning signs with Queenstown and Wanaka to some degree. They've rocketed from $500,000 around 2013, 2014 up to $1 million price points as they've doubled in value over the space of 5 or 6 years. Again, you can see there, interestingly, Christchurch, Dunedin for the first time in history, despite having lower incomes, has overtaken Christchurch. Dunedin has done what it does. Invercargill has done what it does. And obviously with Christchurch being overdue for growth, it's kind of like saying Hamilton can catch up with Auckland and nothing's going to change. For Dunedin to catch up with Christchurch doesn't make sense given the infrastructure and investment going into Christchurch and everything else going on. So, it's the same message if you've been to webinars recently. We run these every, 2, 3, 4 weeks. The consistent theme has been for all of this year that the two outliers right now in terms of upward growth most likely, and on the basis that it's already occurring, is Auckland and Christchurch. Okay, so just want to dive a bit deeper and I guess give you a little bit more of an appreciation of how we support some of this logic with the research we do in the background. On average, for each project that we list for sale, we've done between 80 and 100 hours of due diligence, preparation, packaging, marketing, analysis work to get a project listed and online ready for you to see, and all the analysis and everything else we do is taking us that kind of time frame. So there's other things we do in the background. So I want to just look at just 4 key cities, and apologies for not doing 20 across the country, but this information is available online in terms of the sources of the information. So the market rental data comes from landlord.co.nz. They publish rental data trends graphs that you can do your own graphing, and REINZ publish median price data. So if we start with Hamilton, we say, okay, if we look at the last 4 years, so everything I'm about to show you for Hamilton, Wellington, Auckland, Christchurch is last 4 years. And we can see there over the last 4 years that on average, rents have risen 35% in Hamilton, but on average, the median price has increased by more than double. It's gone from just over around $300,000 price point to around $650 or something like that. So up 111%. So quite simply, if values are rising faster than rents, then yields as a percentage are falling, right? Because if rents aren't rising as fast as values, then those yields as a percentage are dropping. So what that means, of course, is eventually this upward curve can't carry on because investors will stop investing at a point where the yields don't make sense anymore. And from an affordability point of view, if you think about if you live in Hamilton right now, unless your income's doubled in the last 5 years, then you can't keep up. And remember, the caveat is the reducing interest rates are helping to prop this up. They're helping to subsidise the ability for people to be able to afford these types of price points in a location where wages and salaries haven't grown that fast. Jeff, well, it's good timing. Jeff has just asked, will Hamilton market continue to rise due to the new train link and highway upgrades? So yes, Jeff, fundamentally, over the long term, everything that's happening with the 4-lane highways, 2 in each direction, high speed, 110 kilometres an hour, and then the train link from Auckland to Hamilton with a couple of stop-off points, absolutely that will help support the market fundamentally over the long term. But there will always be points at which the median price levels out because you get to the point where affordability becomes an issue for home buyers and for investors as well. So fundamentally a strong market long term, but the key thing is you want to try and invest in rising markets, and when those markets stop rising and get to that sort of correctional leveling out phase for a period of 2 or 3 or 4 years, then make sure your next investments are into the next rising market. So as investors, I really encourage you to think about investing across the country, Auckland, Hamilton, Wellington, Christchurch, Queenstown, and other locations. I'm not excluding anywhere, should be on your list as you build a broad and balanced portfolio, because you always want some parts of your portfolio with rising rents and rising values. If everything you've got is in one market, then obviously you're going to have a great time, and then you're going to have times when you go sideways for 3 or 4 years with all of your portfolio, which means you're then out of the market. And so that's an important consideration. And, ironically, at the Property Factory, 80% of investors who buy projects through the Property Factory don't live in those locations. They're buying because it strategically makes sense. They're buying to balance up their portfolio, and they're taking advantage of using property managers, which are all costed into our cash flows, and other complementary services to manage their investments for them professionally without having to be on site. Okay, so like Hamilton, Wellington's had a similar path. So values have risen 60% on average across the last 4 years. Rents have risen 33%. So again, we've got rents that aren't rising as fast as values are, and so we've got yields falling, which ultimately means at some point, Wellington, after going from around the low 300s to around sort of 500, 550 median price wise over the last 4 years, will start to level off. And we're starting to see a little bit of that. If you look at that graph, we're actually starting to see some evidence of that. And that's looking at Wellington Central specifically. Okay, if we take Christchurch, this is a different picture, right? We can see rents with population growth ahead of supply and playing catch up from the post Christchurch earthquake almost 10 years ago now period. We've seen rents grow 48% in the last 4 years. In terms of that's a Christchurch city average. We've seen values grow about 10%. And you can see there, it's just starting to meander up. We're starting to see that growth from 450 to 500. So we've got what we've got now, of course, because if rents are rising faster than values, then yields are rising, cash flows are rising. It makes it more attractive to investors, makes it attractive to home buyers as well. Okay, and then if you take, Auckland's a big location, so I don't want to generalize. I've got some other data after this to show you, but I just picked a location where we've had huge popularity with projects in the sense they sell out, in days, not weeks. And that's the Te Atatu Peninsula, which is 13 kilometres from the city. And again, as part of the market turning, if you look back to that market peaking in mid-2016, you can see values rose a little bit more, came off the pace, dipped, and are now back to about where they were with a little bit of an upward turn in the last 3 or 4 months. But in 4 years, you could say values have gone sideways. And so what we're seeing, of course, is rents in 4 years have risen 19%. Values have gone sideways because of the correction after the big previous growth they saw from 2009 to 2016. That correction has occurred. So we've got yields rising. So as yields rise and cash flows improve, the market becomes attractive to investors. They start investing, developers start developing, and away you go again. So this data for the country is available at REINZ and landlords.co.nz. I've just picked out those 4 city examples to give you a bit of a flavour for how we look at the market and how we support it with data. So then I took a step back and said, okay, if we break up Auckland into the 6 key regions, and apologies for excluding Franklin, you can see there the old regional city, top left corner. You can see there the rental growth over the last 4 years kind of ranges from 13% to 22%. But, Waitakere leading the charge, other than Papakura, which, although you'd argue has risen faster, it's a long way south of the city, some 35, 40 kilometres south of the city. Our pick and focus is Waitakere at the moment with projects because of that 13 to 20 kilometre radius from the Auckland CBD and the link up through that southwestern motorway out to the airport via the tunnel, and of course the link up via the Greenhithe northwestern motorway across to Albany and the North Shore. So, again, the market hasn't stood still rent-wise over the last 4 years. And, of course, when the market flattens out, there's stocks coming on stream, then rents start to tick up because you've just got population growth occurring, helping to drive that. So hopefully that helps you just to look at the separation of the rate of rental growth versus property price growth to help you better understand what's going to happen next, because that's the kind of data we support it with. This is another chart, and I don't want to bury your numbers, but this is a chart published by interest.co.nz. It's published nationally, but I just grabbed the key city stuff, plus a couple of other comparables. But essentially, what this is a ratio between rents and house prices. Okay, so the smaller the number, the higher the yield. So, for example, in Auckland, the average property is 32 times the average rent. So if the rent's $28,000 a year, the average property value is 32 times that, or $920,000. So of course, the more that is, the higher that number is, the lower your yield is. And again, just to reinforce here, if you look at Christchurch, for example, much lower than the rest in terms of higher yields, lower ratio, more affordable, right? Smaller number equals more affordable, smaller number equals better yields. And you can see there Queenstown, right? A lot of property in Queenstown you would not rent out because it wouldn't make sense. You can see there 42 times the average, but again, there's lots of high value properties. So again, just a sensibility test. And again, if you look at Auckland City, with lots of apartments in the inner city and smaller section sizes, and then Waitakere, again, more affordable than some of the other locations, including Manukau, which is quite surprising. Okay. So let me just jump out of there. I've got just a little chat thingy there. So polls ask, when do you say that a particular area is in 6 o'clock, 9 o'clock, or 12 o'clock? What are the indications? At a simple level, when the market has been flat for 4 years and prices are going sideways and number of sales are dropping and time on market's rising, you'd say it's at 6 o'clock or towards the end of a depressed period. As soon as you get to the point where property selling at the same rate as it was last year and the same volume as last year and values are going sideways, not declining, then you'd probably say it's at 6 o'clock. Once you start getting values rising, i.e. properties are selling for higher prices, once you start getting the days on market dropping, so in a strong market, property will sell in 30 to 35 days on average. In an out of control hot market, the days on market might come down to sort of 17 to 25 days. in a slow, depressed market, it might take 90 days. In fact, sometimes post GFC, we saw 180 days being the average for some more regional parts of the country. In other words, the average probably taking 6 months to sell. When you're at 12 o'clock, generally you've had a number of years of heady growth. You've got a track record where, as we're starting to see, where the growth in values is double or triple the growth in rents, so that yields can't keep up. Those help to start to give you that indication. Days on market dropping, median sale price rising, volumes rising, etc. So they're kind of just a number of numerical indicators. And if you understand those 3 or 4 that are key, then it's not rocket science, and we aim to not make it rocket science. And so just off the back of that, in terms of house and land versus apartments versus townhouses, what's happening right now, I pulled this data together for you today just to really illustrate. So this up the left-hand column here is average time to sell, or median days to sell. Remember, we said sort of 30 to 35 days is a pretty strong market, 20 to 25 is a hot market. You can see here, if we look at Wellington, the green line was a hot market, 2017 to 2019. There's been a lot of value growth. The market started to slow a little bit, but still going strongly. Hamilton, quite similar, but not quite at the heady level of Wellington. But equally, you can see Hamilton's still going strongly, and as a result of rising land prices, I know from a number of developers in Hamilton, they've stopped sourcing land for new projects because the cost of the land doesn't make sense anymore. It's too expensive. So there's less supply coming onto the market. So now we're starting to see property sales speeding up because there's less supply to choose from. Christchurch, we can see the days on market. It doesn't look like a lot, but to drop from 36, 37 days down to 31, 32 days, that's a 20% increase in speed of property sales. That's a good sign, particularly given the amount of new stock that's come onto that market with all the development that's gone on. Auckland, you can see there, flatlining in terms of days on market. So if we go back here, dark blue, market leveled out, late 15, early 16, market slowing down, right? Days on market rising in Auckland, slowing down, getting slower and slower, less stock being built, less stock available, rising population. Now the market starts to level out at about 42 days on market. This is house and land in Auckland. And then we see, due to population increasing, not enough stock available, days on market starting to drop as demand increases. So that's house and land. Apartments, again, similar picture. Interestingly, you can see Hamilton starting to slow down now in the apartment market. You can see there, days on market starting to rise from where it was a year ago. Christchurch dropping. Auckland's, even though we believe strongly in infill housing as a safe investment, you're buying well below median price, you've got good yields. In the city Auckland, there's still issues with apartment stock and apartment volumes. You can see there, days on market, and that dark blue line in Auckland rose up until mid last year. Dropped a little bit, but then rising again. So, the apartment market, even though, a number of locations in Auckland for townhouses and house and land are strong, you'd have to argue the apartment market's still uncertain, given it's still at its slowest rate of sale in 4 years on this picture here. So hopefully just explain this. Hopefully this helps make sense and also to demystify some of what you might hear us talking about or others talking about, or what you might read in the media that often is not up to date because you're reporting data that's already 3 to 6 months old. So townhouses, and this is for the entire Auckland, Christchurch, Hamilton, and Wellington City. So a real generalisation, right? Parts of Auckland, parts of Hamilton, parts of Wellington, parts of Christchurch flying along, parts not so much because of, if you take Auckland, for example, out Papakura, there's thousands and thousands of new townhouses being built, so much stock out there. So there'll be parts of Auckland where stock's selling slowly, then there's parts like Waitakere City, where days on market, particularly Te Atu Peninsula, Te Atu South, Glen Eden, are absolutely flying along and selling out in days and weeks. So, but just helicopter level wise, Auckland sort of flattening out, dropped a little bit this year. Christchurch, channel sales speeding up. Wellington's still strong. It's still at, infill housing. Wellington is starting to reduce the price point and how people get into the market where they were outpriced for the cost of apartments. And you can see there, Hamilton has jumped up markedly from where it was in 2018. And once you start to get to sort of 50 days on market, then the market's definitely slowing down. So just a bit of a helicopter view. And so horses for courses, again, just because we recommend townhouse projects in Wellington where the numbers make sense, doesn't mean apartments make sense. And we're not actively looking for any apartment projects in Auckland right now because we don't believe the market makes sense right now. So we start with location, then we drill down to regional areas and suburb areas within the location, but none of that makes sense right now for us. So that's not our focus. House and land, and then townhouses are the focus, where in Christchurch, apartments make sense. Early stage, non-oversupply, lots of cool stuff happening in the city, lots of population growth in the city. Whereas Wellington apartments, some of them have gone from 450 to 700,000 in the last 4 years. So again, you can get yourself burnt with that. Okay, so we're now going to jump into the part of the webinar that people often ask about. Do I buy for cash flow? Do I buy for capital growth? What numbers make sense? What's the golden rule? What's the silver bullet? And hopefully by now, with a property factory, there is no silver bullet. All right, so we want to build a balanced portfolio as we grow our portfolio, and that's all kind of common sense. A couple of questions here. Roy's just commented, Hamilton has a large amount of land around the city and it's getting expensive. Do you think it will be the same for Christchurch in the future, given it has a massive amount of land too? So that's the irony, Roy. If you look at Christchurch, there's a couple of things. First of all, inside the 4 Avs, it's part of the new city plan. There's, of course, a height restriction for residential property of 3 levels for townhouses, and I think 4 levels from memory for apartments. So once that's built out, it doesn't matter how many low-rise buildings you buy up, you can't demolish them and build high-rises. So that's a little bit different. Wellington and Hamilton don't have that same height limit, nor does Auckland in most cases, in most locations. And so that controls supply versus demand. And then if you think about Christchurch as well, then from a house and land point of view, Christchurch is a large location that can sprawl. I mean, Christchurch could have 5 million people. It could sprawl all the way out to the Southern Alps. There's so much farmland out there. So the city has to do a good job of managing the growth so they don't have sprawling infrastructure issues. And right now there's a massive motorway extension that goes from North Canterbury into the city centre. That means if you live on the northern side of the city and your commute time might be 45 or 50 minutes right now, you should be able to cut 20 minutes off the commute time with a new 4-lane motorway that's coming into the centre of the city. That's going to open up that land all the way north of the city. So, it's supplies available, and then there's how fast the council releases it. But Christchurch has got a long way to go, given the price points are nuts. I mean, the fact that you can buy, we had a project we released last Friday, all sold by Monday. $359,000 to $389,000 2-bedroom houses with car parking, 1.6 kilometres from the city centre, positive cash flow. Nuts in terms of price points and cash flow. So I'm not sure if that answers your question, but definitely, yes, Hamilton land's getting expensive, which is why development's slowing, which will then push up prices and rents further. Okay, so we want to build a balanced portfolio. Banks focused on our equity, focused on what cash flow we have, what income we have, and focused on our track record, our credit rating, our character, etc. So, with property, 90% of your wealth will be from capital growth, but of course, cash flow is what pays for the cost of building a portfolio. And once you get 10 to 15 to 20 years down the track, and rents have increased again, you start to build some pretty good cash flow surpluses from a lifestyle point of view. So in terms of buying for capital growth, then the majority of our wealth comes from that. And if what we do is we take a long-term view of suburb performance, and we use a 20-year growth average in all of our analysis as the average capital growth rate to assume. And we're also looking for projects and locations where there's a good growth story ahead because of motorways, infrastructure, something else changing about the location that'll help raise the bar. So I don't know if you've heard of the rule of 72, but it's a good rule to keep in the back of your mind. And the rule of 72 is quite simply, if you take 72, if you divide it by the annual growth rate, then the result will be the number of years it takes to double in value. So here's an example, right? If my annual capital growth rate is 7.2% per annum, then 72 divided by 7.2 equals 10. it means that that suburb's going to double in value every 10 years. And so often when we look at a growth rate and we say, well, there's not that much difference between 7 and 8 or 7 and 9, I guess this illustrates, if you think about this, that the difference between 7.2 and 8% is an annual growth rate, or 9% is an annual growth rate, means that our portfolio doubles in value and doubles in value again at a faster and faster rate. So equally, if you buy in a location where the average growth rate is 4%, then of course 72 divided by 4 is 18 years. It's going to take 18 years to double in value if you buy in a 4% growth rate location. So what we do at the Property Factory on the website, which hopefully you've seen, if you want to rank the projects based on their KPIs, we automatically have a view there based on highest capital growth rate that automatically sorts of projects from top to bottom based on the long-term 20-year average. So that analysis is done for you. Okay, so let's talk about buying for cash flow. So while capital growth is pretty key, cash flow, of course, funds your ability to build your portfolio, and it takes the pressure off personal income if you're building a self-funding portfolio and not having to top up your mortgage payments or expenses from your business or from your personal income. When we do the analysis, when our members submit requests for the investment capacity reports that we provide as complimentary as part of our service, 8 out of 10 investors are weaker on income than on equity from the bank's point of view in terms of what the bank looks for portfolio funding. So, for us, a lot of our focus with our members is to help them build out that weaker side of the portfolio so they don't run out of borrowing power. And the other thing I encourage you to do is use net yield, not gross yield, for like analysis. And I'll explain why. Okay, so let's just say we purchase house and land, let's say it's brand new, and the gross yield is 5.5%. So that's our rental income divided by the purchase price. And our expenses, when we add up insurance and rates and body corp and property management, et cetera, are about 1.5% of that property value. So our net yield, after we take those costs out before paying our mortgage, is what we call a 4% net yield. So in that example, we're going to have minimal maintenance, no body corp. It's a brand new property, so we'll generally have lower vacancy rates, and we'll get higher rent, higher than average in that location because it's a new property. Let's say we're comparing that to a new apartment where it's just got a much higher gross yield, much higher rental income as a percentage of the property value, but because we pay for body corp fees as well, which are a way of paying for the shared costs in the building, the swimming pool, the foyer, the lift, et cetera, the grounds, the gardens, the gymnasium, what have you, we share the cost of maintaining those areas. We'll often have higher expenses. But in that example there, the net yield could be 4%, still could still be 4%. And so often I hear investors saying, I wouldn't buy an apartment because I don't like body corp. Well, it depends. It depends what the gross yield is. It depends on if the facilities in that building, i.e. the gymnasium, the swimming pool, the rooftop bar, the whatever, make it more attractive for tenants, so you get great tenants who pay a premium rent. It's all relative to the return. But in that example, you can have higher gross yield, higher expenses, and still the same net yield. And again, minimal maintenance because it's a new property. You'll have body corp fees where you might have little or no body corp with a townhouse. Again, lower vacancies, higher rent if it's well managed. And then if we talk about older properties, which can sometimes have higher gross yields in some cases, but because they're older, our budget for repairs and maintenance is significantly higher. Then again, on that kind of model, particularly if the property's not as well presented, sometimes we can have higher vacancy rates. And of course, if it's not a new property, it's a second-hand property, it doesn't look as good in some cases, the rent will be lower just because of a function of people pay more for better quality. So I encourage you when you're buying for cash flow to do your analysis based on net yield and what have I got left to pay the debt costs or the mortgage costs after I take out the expenses, because net yield is what is apples for apples, not gross yield. Having higher yields but higher expenses, higher vacancy rates, higher repairs and maintenance isn't necessarily a better result. So again, when you go into the members dashboard and into the current projects, again, we've got another view in there where we've pre-sorted all the projects based on highest net yield to highest to lowest net yield, so you can see the result after the expenses are taken out, so you've got a like-for-like result. So hopefully me explain this helps you to understand the method in our madness and why we do what we do and why we talk in these terms for this reason, so that you've got like-for-like. Because this is how we look at property, right? This is the business we're in. We're in the business of investing. This is how we look at it. Okay, so often, the question is, do we buy for growth or we buy for cash flow? Well, you want to buy for both, and you always buy for both. And let's face it, when you're buying in key locations now, where you've got good population growth, then you're going to get cash flow and you're going to get growth, particularly with current interest rates. So then it's a matter of saying, okay, well, if I add the two together, if I add capital growth rate to the net yield to work out total return, what does that look like? And it's often the best method for comparing properties and locations to say, what's my total return? And so, for example, again, we've got people that are fixated on high growth locations where the yields could be low, resulting in quite negative cash flows, maybe negative $5,000, even $10,000 a year. And so in this example, high capital growth rate, lower net yield, total return 12%. A different suburb might have a more moderate capital growth rate, a slightly higher net yield with total return of 10%. And then we might have a secondary regional location or an area where population growth is slow or non-existent. We'll get much higher yields or much higher cash flows, but that's because we're getting lower capital growth rates. So looking at the total return gives you a like-for-like picture and the ability to compare those things. And of course, without yield, you can't fund it. Without growth, you won't create your true wealth. And again, with a property factory, one of the other views you have is a comparison of the combined net yield and capital growth. So I just want to explain, why we do that and the numbers behind it, so that you can see, okay, we can now look at these projects and say, can we take a combined view? Is that a different picture to just looking at growth or just looking at cash flow? So again, hopefully that makes sense, and hopefully that helps you understand why we do what we do. All right, so moving along at a great pace here, and we should be on track to wrap up and go to questions in about 8 or 10 minutes. So in terms of a project analysis or a case study, I want to just quickly, explain the property investment analysis that we do on a project. And so just give me a second on this here, and I will, I'm just going to take a project that we listed just this week in Addington Christchurch Townhouses. So I just wanted to show you, talk a little bit about the numbers, so that you understand, how all this comes together from a project analysis and why we look at what we look at. So obviously we do the standard stuff around price point and the size of the project. We always measure how many dwellings in a suburb have 1 to 2 occupants based on census data, because if you're buying a 1 or 2 bedroom property, you want to understand how big is my target market. And the irony is, these days, it's a bigger chunk of the market than 3 or 4 bedroom properties. And we also put in data around household incomes, because of course, if you're renting a property out that's brand new, where you're going to get above average market rents, equally you want to understand there's enough people there that can afford to pay above average rents for a nice property in a nice location. Okay, you can see here the question earlier about property clock and where's the market at. So as part of doing the analysis for this project, and this is in Addington, a suburb, I think 3 or 4 kilometres out of Christchurch CBD, looking at the data that markets at 6 o'clock, whereas we've got inner city Christchurch or suburbs like Sydenham, where the market's already at 7 o'clock because of the growth that's occurred in the last 6 to 18 months. So in terms of the other information here, suburb performance is about the average. So this market rent data, based on 1 beds and 2 beds, comes from tenancy services. So based on bond lodgements, that's where that comes from. And then the 10-year total growth and the 20-year total growth is data from the INZ charts that we use to then calculate the 20-year compounding average. So again, this is an Addington townhouse. We put in, we insert the 20-year townhouse and house market data. You can see what Addington's done compared to the New Zealand average in terms of the growth and that market going sideways now for 5 years or so. We put in annual volumes. You can see there's enough demand in this market. So if you need to sell the property, you want to understand there's enough demand in terms of potential buyers. And in this suburb alone, 80 to 100 house sales a year, days on market. So we talked about that before. We can see 28 days on market. That's pretty healthy. Below 30 is pretty healthy. You can see that there were some slower periods. That's consistently risen a little bit and then come down and down and down more recently. And again, total value of that market on an annual basis, number of house sales times average price, it's a $25 million market, $25 to $35 million market. So again, a reasonable kind of market. So all this information is in here to help you do your assessment on where the market's at, but also to understand why does this suburb make sense compared to some other suburb. The assessed rent always has a range because almost every project has two rental assessments, and each property manager will give a range of rents. And so I think in this project's example, one said 320 to 360 and one said 350 to 380. So we put the total range in and we take the average when we do the cash flow analysis. We don't take the high, we don't take the low, we take the midway point. And it's the same for the two-bedroom property. So those cash flows that are quoted are the weekly cash flow after all expenses, after property management, after paying the interest on borrowing 100% for the mortgage. That's what their cash flow is based on. And then in there you can see the stock that's under contract or sold and the stock that's still available from a property and price point of view. And then down here we do a number of things in terms of giving you the assumptions we've used for the analysis, and then these are all downloadable documents that are available to you to use as well. So a couple of cool things that I just wanted to point out. Suburb demographics links to the one roof suburb profile, and that's where we get that data of how many people live in each household, what the average incomes are, et cetera, all of that information is available here. So take advantage of that information because it will help you get a feel for the suburb, who lives there, what they earn, what kind of work they do, et cetera. Okay, so I don't want to spend a lot of time on that, but I wanted to just spend some time on it as part of talking to you about analysis because, again, one of the things that we often, skim over is the property investment analysis process. And you can see here, when you boil all this down now, and I've driven I've pre-marked this, you can see that in terms of the rental yield versus the net yield, the difference is those expenses that we take out on this property. And you can see here, we've allocated these expenses down the left-hand column here. Nothing for maintenance costs in the first year because it's a brand new property. And even conservatively, we've put maintenance costs in there for years 2 onwards, even though it's a brand new property, you shouldn't have any of those costs. We've factored in property management at 10% of the rent, and we've factored in the 20-year growth average, which then calculates what the value will be in 10 years' time, $739,000 against a $425,000 purchase price today. We take that weekly rental income of $415 a week. We allow for a week's vacancy. We take those costs out, and we get to annual cash flow of about $1,039 per year or $20 a week. That's how all those numbers are done. So all those are downloadable on every project for 1 bedrooms and for 2 bedrooms and for first-time buyers, et cetera. So that information is there for a reason, and if you need us to explain it for you, then our team will happily take you through that. Okay, so at the moment we can't release new projects fast enough with the speed at which they're selling across the country and in which they're selling through the Property Factory. But we've added these are 3 projects, 2 of them in the last 3 weeks, and one where there's 3 townhouses remaining in a really nice prime Auckland suburb. But again, go online, check those out, do your own analysis, look at the graphs, look at the charts, look at the capital growth rate versus the cash flow, et cetera. And again, these are all positive cash flow properties, anywhere between sort of $1,000 and sort of $4,000 a year in positive cash flow after all the costs are taken into account. And this project here in Russley, near the Riccarton Racecourse, this discounts below valuation of up to $32,000 because the developer needs to clear out the project. They need to sell the last 7. They're all 2-bedroom townhouses that are left now. They want to get the project closed out and move on to the next one. Okay. So if you haven't done it already, then as a member, first of all, if you're not a member, go sign up because it's free. So why wouldn't you? Just click on the join button on the top right-hand corner of the website. If you are a member and you haven't done it yet, click on the investment capacity report and request an investment capacity report. And what it does is, based on you supplying 6 pieces of financial information, which takes you about maybe 2 minutes, maybe a minute, We then produce a 6-page report looking at your starting point today and 3 different scenarios for you over the next 10 to 15 years based on what your starting point today, and then a conservative, a typical, and an aggressive plan to grow your portfolio to work out what that might look like. So that's just part of our service. We encourage you to request that, because that also will tell us and tell you where you're weak and where you're strong, whether it's equity or whether it's income or whether you're balanced, so that you know what you need to do next or buy more of, either for income or for growth, so that you can move yourself towards a balanced portfolio if you're weaker on income or weaker on equity. So take advantage of our website, talk to our team, request an investment capacity report. If that's not enough for you, when we take you through that and talk about your strategy, we can help produce a property matching report, which goes to a more scientific level and helps match the exact type of property to what you need to do next, and gives you some scenarios and shows you how they might look. And it also helps you to understand that if your goal is to get to $50,000 or $100,000 or $200,000 in terms of surplus cash flows in 10 to 15 years' time, it helps you work out exactly how many properties you need, how often, to get to your goal, to really turn it into a mathematical equation. So spend time on the website. The average property has about 100 pages of documentation in terms of the reports and the forecasts and due diligence and plans and all of that kind of stuff. And ask our team any question you like. There's no such thing as a stupid question. There can be stupid answers, but there's no stupid questions. Our goal is to demystify real estate investment, make it easy for you to understand, and really to help work with you over the next 5 to 10 years to help you build your portfolio. Our service is free. It's free to members. We work diligently for our buyers and our investors. We're paid as a real estate agency by the developer, just like Bailey's and Ray White and what have you are paid on the sale of those properties. The difference with the Property Factory is we focus our services around how we help the investor build a portfolio, more so than being property-centric from a sales point of view. So talk to your mortgage broker. Make sure you get pre-approval so you know what you can borrow. Pre-approvals are still happening. They take longer. They are a bit harder. Be persistent. My last one took 9 weeks. It's just a process to go through, but it's worth it, particularly right now in a rising market where we're seeing values growing and the market heating up, and the opportunities that are there for you to take advantage of. We help you with arranging inspections of properties. We help you with making sure that you get valuations underway prior to settlement. We help you with arranging property management and making sure your tenants lined up to move in before you settle. We work with a number of different companies that are good at that stuff. So again, we can help you with that. So take advantage of our services. We're here to help, and we've got lots of happy investors that are doing great things at the moment. So that literally is our webinar for tonight on time. And now I'm going to jump into any other questions that have come through as well. And if you've got questions, type them in and send them through, because now is your opportunity. I'll read them out and answer them. Okay, so Roy has asked, can loans include the closing costs? So Roy, yes, they can. So, at the end of the day, if you're borrowing money to buy a property and you've got enough equity and security, you can then borrow to cover any loan application fees, valuations, legal fees. So yes, you can do that. And we always factor into the property investment analysis $2,000 for what we call acquisition costs, which essentially are those closing costs. So we encourage you to budget for that, and yes, you can include that in the settlement proceeds, so that you can settle out of your loan drawdown rather than your back pocket. Okay, Roy said, great presentation, awesome, thanks David, love it, cool, you are welcome. No problem. So any questions at all on what we do, why we do what we do, any other analysis questions, any other market questions, feel free to fire those through. We have recorded this. Gabrielle will have this bundled up and sent out in the next couple of days. If anyone that misses it or came in partway through it or wants to share with anybody else or what have you, so take advantage of that. And, if you go to the blog section on our website, all of our pre-recorded or past recorded, webinars and videos are there, market reports, podcasts, take advantage of all that stuff. And, it's a significant opportunity we have in New Zealand right now, I think, with what's happening globally, as disruptive and as unfortunate as it is. Our population is growing at a faster and faster rate. We are going to be highly sought after as a location to move to invest in, as a safe haven. And while we can benefit locally by investing in a healthy property market, at ever lower interest rates, which is an investor's dream, while global uncertainty helps to suppress those rates, then we've got a huge opportunity to take advantage of it. So Isako's just asked, would you have a deal analysis spreadsheet or software we can use to analyze deals? So yes, we do. Let me just show you. I'm glad you asked. In the website. So again, if you log in as a member, and if you go to the members dashboard, hope you can see it on the screen right now. You go into community resources, and also off any of the projects as well. You'll see in here that there is the analyzer software, first home investor software, the first home buyer software. All those are free and downloadable, Asako. They're available for our members to use, so you can do all of your own analysis. So again, we put those there so you can crunch your own numbers, put your own variables in, put your own vacancy rates in, put your own rents in, etc., etc. But equally off each of the projects as well. When you go into the projects, those are all available off the bottom of each project. The same down the bottom there, same deal there. You can download. Just click on the blue link. You can download that. It does run on Microsoft Excel, so you'll need to. I think you can download an Excel viewer for free if you need to. And again, you can save it as many times as you like and save it and name it for different properties. So take advantage of that, because we're here to arm you with the tools, not sell you the tools. We succeed by helping you build a successful property portfolio. So that's our focus. Okay, 2 more questions. How do we get in touch with your team? Okay, I'm glad I'm on the website. Through any of the projects, there's a contact us button inside a project. Also, if you just go to the footer of the website there, see that footer that says, contact our team. If you click on contact, it creates a contact form. If you click on our team, you can see there, you can email our team. And there's also the phone numbers for our sales team as well, so you can give them a call. So lots of people on our team. We're a real business. There's real people doing some pretty cool stuff. So you can contact any of our team directly, and they are here to help. So take advantage of that. All right, next question. We had Jeff says, when I go onto the website, it shows the price and detail of each house. It doesn't show availability like your screen showed. Okay, let me just show you that, Jeff. So hopefully you've gone into members dashboard at the top of the website. So that's quite important. If you just go into current projects, then all you'll see is just a helicopter level summary, right? So you want to go into the members dashboard. Then you want to go into current projects. And then once you're in current projects, you can either just click directly on the latest releases. We always show you the latest sort of 4 or 6 here. Or if you go into view projects by list, then within there you've got summary numbers of those projects from a cash flow point of view. Then just click on the picture that you like, and that takes you into the project, summarizes all the information around the project. And then if I scroll down here, you'll see the availability information, and that's live. So when I say live, when somebody submits a contract request, or either a request for contract or a secure property now, takes you to a request where you can say, I want this property, please prepare a sale and purchase agreement for me. Our contracts manager, Astrid, will then update the status from available to reserved, and then under contract, and then eventually sold once it goes unconditional. So and again, one of the biggest bugbears with real estate that a lot of people have is you ring the real estate agent and it's already sold last week and they haven't updated the ad, or the developer won't give you a stock list, so you don't know what's available, what price points. We make all that available transparently for you to make it easy, so you can get all the information online without having to contact us, so that if you're doing it at night or on the weekend, we're not holding you up. So Jeff, hopefully that helps answer your question, and just, again, don't hesitate to contact us for some extra support or help, but hopefully that helps you to get access to the information. So let us know if you're stuck for any reason. We're here to help. Do you suggest any mortgage brokers? Yes, we do. We have mortgage brokers available that we recommend. Again, if you contact our team, they can steer you in the right direction. Equally, if you go into any of our projects and you click on the request for contract or secure a property now, on that form, In that form in there as well, we have mortgage brokers and solicitors listed in that form. And again, we work for a number of people across the country. We're not mortgage brokers. We work with specialists who specialise in investors. They're independent. They're across the country. And again, you can see those details are all in there in the request for contract form. But again, have a chat to our team. Some of these people specialise in first-time buyers. Some are specialised in investors. Most are investors, but again, we can help steer you in the right direction with that. So, okay, one more question here. Asaka's also asked about in-house mortgage broking services. So I just answered that question as well. So cool. So that's all the questions so far. So bang through any other questions now before I sort of wrap up, so that I can let you get on with your evening. And thanks for all the good questions you've asked. And certainly don't hesitate to take advantage of what we do and how we do it. And we're obviously here to help. And make sure you take advantage of the resources we offer and the help we offer, and don't hesitate to contact our team at any time for any help at all, because we want you to take positive steps in the right direction and just build a great portfolio that in the next 10 to 15 years provides all sorts of choices and options for you. Masaka says thanks. So folks, if there's no other questions, I'll give you 30 seconds to type those in. I'll wrap that up there, and thank you for putting aside an hour of your evening to spend time on the webinar tonight. Hopefully that's helped add a bit of a technical and mathematical and scientific level to help you better understand markets and analysis and cash flow and that kind of thing. And again, everybody's situation is different, so yours is going to be different from somebody else's. So again, don't hesitate to talk to the people that can help you to make good decisions based on what you're looking to do next and what you're looking to achieve over the next 5 to 10 years plus. So I will wrap up there. Thank you very much, and we will end the webinar there, and I'll see you online again soon.